How credit card companies trap you, 7 secrets exposed. Introduction. Credit cards have become ubiquitous in everyday life, allowing consumers to purchase goods and services without immediate payment. However, behind the seemingly innocent beep of a card swipe lies a complex financial system that banks and issuers utilize to maximize profits. Understanding the hidden secrets behind credit card operations can empower you to navigate the system more effectively and avoid common pitfalls that could lead to unnecessary debt. This report explores 7 lesser-known credit card tactics that banks use to profit from consumers, and how you can protect yourself from falling into their traps. Footnote: credit cards may seem like a simple convenience, but they come with hidden costs that can catch unaware consumers. 1. The teaser rate trap. Many credit card offers include attractive teaser rates, promising 0% interest for a year or even 2. This seems like an excellent opportunity, but the devil is in the details. These low rates are often only temporary, and if you fail to pay off the balance before the promotional period ends, interest is retroactively charged at the standard, much higher rate. For example, if you purchase a $1,200 laptop with a 0% introductory rate but carry a $100 balance beyond the promo period, you could be charged backdated interest at a rate of 22%, causing your debt to snowball. The key takeaway here is that the clock on the 0% interest is far more critical than your actual balance. The bank hopes that you forget the deadline, so they can apply interest charges to the entire amount retroactively, significantly increasing the cost of your purchase. Footnote: promotional rates often conceal the true cost of purchases if not paid off in time, leading to high retroactive interest rates. 2. The minimum payment mirage. Credit card companies often list a low minimum payment on your statement, which may seem manageable at first glance. However, making only the minimum payment will likely keep you in debt for many years, with significant amounts paid in interest. For example, on a $2,000 balance at a 19% interest rate, making the minimum payment would keep you in debt for over 12 years, ultimately costing you more than the original purchase. Conversely, paying a little more than the minimum, such as an additional $50 each month, can significantly shorten the repayment term, reducing the amount of interest paid and helping you pay off the debt faster. This highlights the importance of not simply adhering to the minimum payment, but rather making extra payments to accelerate debt repayment. Footnote: paying only the minimum payment on a credit card balance can significantly increase the total cost of the debt over time. 3. The due date shuffle. Many credit card issuers manipulate due dates to increase their profits. For example, they may set the due date at 5 p.m. in a time zone that is not yours. If you make a payment after this cutoff time, even by just a few minutes, you can be charged a late fee and possibly face an interest rate hike. Additionally, issuers may alter due dates around holidays, taking advantage of your busy schedule to increase the likelihood of a missed payment. To avoid these hidden traps, it is advisable to set up automatic payments at least a week before the due date to avoid late fees and interest rate hikes. Additionally, setting reminders for the payment date can help you stay on top of your obligations. Footnote: credit card companies may manipulate due dates to increase the likelihood of missed payments and fees. 4. The utilization watchtower. Credit card issuers monitor your credit utilization ratio, which is the amount of credit you're using relative to your credit limit. This ratio is an important factor in determining your credit score. Even if you pay your balance off in full before the due date, if your balance is high on the statement closing date, it can negatively impact your score. A simple strategy to avoid this is to pay off most of your balance before the statement closing date and then pay the remainder before the due date. Additionally, if you have multiple credit cards, rotating usage and making small, frequent payments across different cards can help keep your utilization ratio low and boost your credit score over time. Footnote: managing your credit utilization ratio is key to maintaining a high credit score and avoiding interest charges. 5. The reward rebate illusion. Credit card rewards programs, such as cash back or points, can seem appealing. However, these rewards are often far less valuable than they initially appear. In many cases, the rewards come with conditions that make them less valuable, such as requiring you to spend more than you typically would just to earn rewards, or erasing your points if your account becomes late. Additionally, rotating categories that offer higher rewards, such as 5% back on gas, often come with caps, meaning you can't earn a significant amount unless you're careful. The real trap is in the merchant fees that banks collect every time you swipe your card, while you only receive a small portion of that in rewards. It's essential to use credit cards for purchases you would make anyway and pay off your balance in full to truly benefit from rewards. Footnote: credit card rewards often come with hidden limitations that can make them less valuable than they initially seem. 6. The hidden insurance upsell. Credit card issuers often offer payment protection or credit monitoring services, which sound like a good deal at first. However, these services come with hidden costs, such as interest charges on the premiums, and often provide minimal coverage. Payment protection, for instance, usually only covers a few months of payments, and exclusions may apply based on your job status. To avoid these unnecessary costs, always opt out of these services in writing. Be vigilant in reviewing your statements for any unexpected charges related to insurance or monitoring services. Use the free credit reports available to you under the law rather than paying for credit monitoring services that may not provide additional value. Footnote: credit card issuers may upsell unnecessary services like payment protection and credit monitoring, which can incur hidden fees and costs. 7. The credit line cliff. A credit card issuer may suddenly increase your credit limit, which can feel like a reward. However, this increase can also lead to higher spending, increasing the bank's profit from every swipe. Worse, in times of economic uncertainty, issuers may slash your credit limit without notice, leaving you with a high utilization rate that negatively impacts your credit score. To avoid this trap, maintain low credit utilization, and avoid getting too comfortable with higher credit limits. Keep your emergency funds outside of credit lines to safeguard against unexpected financial shocks. Footnote: a sudden increase in your credit limit may lead to overspending, while a decrease can negatively impact your credit utilization ratio.